Thank you so much for joining us, everyone. I am Jason Voss. This is from the Research Chair. It is a Focus Consulting Group podcast. And Michael, tell them a little bit about yourself.
Well, hello, everybody. I am Michael Falk. I'm one of the partners at the Focus Consulting Group, and I have a long background, which just makes me old, in the area of investments. Think of it as a third, if you will. Private wealth, institutional money management as a CIO, and now consulting to money managers around the world. I have a great passion for wanting to keep the active management business alive and thriving. And that's why Jason and I are here to kick off our first podcast from the Research Chair.
Yeah, and a little bit about me, for those of you who don't know. We saw on the registration list about a third who were friends of Michael, a third friends of mine, and a third just various friends of other folks we know. For those of you who don't know, I began my career as a pension consultant way back in the day, then was a research analyst and PM for the Davis Appreciation Income Fund. Was fortunate enough to have done well enough that I could retire back in 2005. In the intervening period before I re-entered the workforce, I was an author, wrote a book called Intuitive Investor. I know, Michael, you've got a couple of pubs. I bet you'll pepper those into the discussion. Then I worked at CFA Institute as the Global Director of Content, and more recently, I've been working with Focus as a consultant. I, like Michael, share a deep passion for active investment management and am a believer in the human potential of human beings and what we're able to do when we're unfettered by various obstacles. And that's one of the central focuses I think we'll see over the weeks as we do from the Research Chair. And I think, Michael, you didn't say it, but I think we want to have a lot of fun. I mean, I think when we thought about and contemplated this, we were talking about how much fun it would be to talk about investments in sort of a free-flowing environment.
I thought I'd start on the serious note and then make them happy that it's not all serious, but make them think that there's actually going to be some substance here.
Well, indeed. And so some of the topics that we are sure to cover over these many weeks, because we're thinking we're going to continue this for as long as there's interest in doing this. Alpha wounds, those are things that investment management firms do, active ones obviously, that hurt their ability to generate alpha. And that is collected information from our various journeys, Michael's and mine, both as consultants and as practitioners. Another is skills that separate you as an investment manager, subject that we, I think, have a pretty good amount of knowledge on. And we're going to be talking about behavioral biases, and it may be the case that we share some of the secrets for how to overcome those, though that is kind of top secret information for which we'd like to get paid, of course. But then we're also likely to talk about things like most misunderstood investment topics based on our time spent out in the field. Michael, what have I missed?
Wow, I'm not sure if you missed anything, but listen, the human element is so important. I don't care what the technology is going to bring, and I've written about this, about AI. The reality here is AI has to use large data sets. Simple as that. Large data sets are historical data. If any form of regime change, AI is not going to help. Any very new type of period of time, different behavior that's evolved in different ways, AI can't help. Great for digging into research elements and expedite research, but in terms of decision making, we need people. We need you. And we need to help you be capable and interested enough to get to the next levels of your own personal strengths to work with that tech and be better than ever in terms of bringing it to your clients.
Yeah, even though it wasn't scheduled for us to talk about today, I think that bears some sort of emphasis on our part. I've served on the board of an AI company, and their previous clients were the U.S. intelligence apparatus as well as the U.S. military. And the founder of that firm, who has quite a few patents in the AI space dating back to the late 70s, early 80s, agrees that there are many things that human beings can do well that probably will always remain out of reach of AI. And Michael, the big one is that capital C, that letter C, context, which you and I spend quite a lot of time talking about. Well, the topic for today, besides introducing our podcast to you, is really just that. What is the future of active investment management? What's the future of the investment industry? What's that look like going forward? And then after Michael and I have some discussion about that, we have several polling questions that we're going to ask you. Some of them are demographic, because that will help us better craft our anecdotal information that we share with you or data that we share with you. Then we're going to ask you what you would like to see. We have quite a broad menu that you could order from as participants. We love the idea that users get to tell us what they would like to hear from us. That will be part of the poll. And then regarding what we talk about, the future of active investment management, we're going to ask you sort of what your perceptions are, and then we're going to open up to discussion. And for each of you, this should last probably to about the top of the hour. Again, Hansi and other folks from the subcontinent on the 10.5 hours ahead time zone, it will be the bottom hour for you. So Michael, I'm going to ask that question of you. What is the future of the investment management business look like, and especially for active?
Well, every time people get a little bit depressed or go dark about the industry, I said, listen, there are dollars that need to be invested somewhere, whether we want to call it sovereign or pension or DC. I don't care how you label those dollars. There are always going to be dollars that need to be invested. So the real question for the industry is, how much do you want to be a part of that? How much do you want to be part of managing some of those dollars? Because they're going to be there. So the future of the industry, active, needs to be active. Let me define that real quickly. Closet indexers, please come out of the closet. You can't stay there anymore, and you need to start pursuing real active or leave into a different part of the industry. Reality, if people are going to pay active fees, they deserve a real shot at alpha. And that means more concentration on average. That means less constrained in terms of a style box on average. And that means different fees. If people are going to make a bet on active, they shouldn't be a all or nothing, win or lose. They should pay higher fees when there's alpha, and they should pay lower fees when there's not. And I know some people out there don't like performance fees, but I'm not talking about the hedge fund format. I'm talking about a different structure that if they want, we can get into. I've written it, it's publicly available, so I can share it on this podcast.
Yeah, I'm of a like mind, Michael. I've commented about this when I was at CFA Institute. I was one of the lead authors of Future State of the Investment Profession, where we sort of put out there what we thought the business was going to be. Our time horizon as authors of that document and researchers was 7 years. I think it was published 3 years ago now, so we're 3 years halfway through almost that perspective, or that prospective future. And I was also interviewed by Bloomberg View back in late 2018 about my view, and the headline of that article, I think, kind of says it all. It said, active management survives, but it's like vinyl, or something to that effect. And by vinyl, I'm revealing, of course, that I love music. Michael, I know you shared that as well. We're audiophiles, folks. And vinyl records are long thought to be sort of the higher quality medium for conveying music. And I disagree, by the way, but I did compare it to vinyl in my interview. I think active survives. I think it also, Michael, you suggested and alluded to the fact that business models might have to change, how people earn their money might have to change. A comment on that. If you think about it, we clip a coupon off the pile of assets under management has some interesting assumptions in there. One, that clients care about that. Meanwhile, I don't think any of us on this podcast today has ever heard clients say, hey, you know what, I want the firm that has the highest assets under management possible. And so they tend to focus on many other things besides that. Yet that is the pricing model. The other thing it says is the only thing we need to know about any firm is what it manages and how much it charges for that, how much it manages. And yet active management's a luxury good, I would argue, not a commoditized good, yet it's got a commoditized pricing model. Now, nobody did that by design. We just did it sort of unconsciously as the industry evolved. But here we are in 2020. There seems to be a fork in the road, right? We're going to go all passive, or we're going to go toward active. Both will probably survive, but then the question becomes, what is that pricing model? So that's something we'll consider, I think, probably. And Michael, I'll turn it over to you in a second. The other thing I want to amplify that you said, Michael, was I think that active will probably ask for flexibility in its charters, right? Its prospectuses, whatever the document's called in your jurisdiction, that governs the relationship between shareholders and what you do. I bet if you are really qualified as an active manager, you can truly deliver alpha. You're going to want more flexible charter because you're going to want to deploy that skill on a larger fishing pond in more ways. I'll pause, Michael.
Well, and let me give you a specific example. Jason and I did some deep work with an investment team recently that was a small cap manager, small cap equities, US focus, just for clarification, everybody on the call. And every time they picked a winner, they had to sell it because they wanted to stay style consistent. And listen, when we're blessed with winners as investors, why would we want to get rid of them out of our portfolio? So isn't it the job that you pick stocks that ultimately become bigger, better companies? Well, if you can't own them through that, that seems to be a problem. But the style police have wreaked havoc on that topic specifically. Listen, before people think that I am slamming style boxes too much, back in the late 80s, early 90s, when they came into existence, yes, I was working in the industry then. When that happened, that was a good service. That was a beneficial education for the industry. The problem is the pendulum swung too far and people started to base their money management on the style boxes. And it gave consultants a raison d'etre, which was horribly unfortunate. We need to go back to what the industry was to a little bit in the past. And listen, I'm not getting nostalgic, folks, but before the style boxes, great money managers went wherever they found great ideas to invest in based upon their strengths. We're going to go back there because that's where people can have confidence. That's where they would be willing to be more concentrated. That's where they'd be willing to bet their income to some extent on their success.
Yeah, Michael,
like everybody else.
Yeah, Michael, I'm going to join in there because it's interesting that evolution of the style box. For those of you who don't know on the podcast, one of the books I authored was just published last fall called Return to the Active Manager. And I tried to trace the history of where it came from. And it's obviously from Chicago because Morningstar launched it, but just several months prior to the launch of the style box by Morningstar, FEMA and French, because they had in place an intellectual capital staked on the efficient market hypothesis, they had to acknowledge growing evidence of anomalies within that hypothesis, right? Is it the strong form or is it the weak form, or is it, somewhat strong form of efficient market hypothesis? Anyway, at their annual event, they acknowledged two effects, the small cap effect as well as the value effect. And shortly thereafter, Morningstar comes out with, guess what? Those two things on an axis. And I would love to know anybody at Morningstar who actually was participating in the germination of the style box, but it appears that Morningstar was trying to do a good thing, to Michael's point, which was after the fact, describe for prospective investors and their advisors, how is it that this manager is delivering value, right? If we take as given efficient market hypothesis, which at that time many people did, Morningstar said, hey, this is one of two ways that they must be delivering it. All great as performance measure after the fact. But as we all know, the industry has evolved, right? So that it's actually a target to manage to ahead of time. And I think that's where some of these problems arise.
And play this out. Let's say you've got one of the best value managers ever. They consistently buy stocks that are severely discounted that then return to fair pricing, if you will, right? They would never sit in a value style box. They would consistently show up as a growthier manager because they buy cheap, but they actually consistently win. So the people who are consistently buying value and have to sell when it becomes fair price are counting on an incredibly high batting average because they have to sell their winner. Another example of where the box is constraining us.
Yeah, I will point out, I used to have as a presentation an animation, which always failed in the middle of the presentations I would give. And I chose a manager, a value manager. I think it was a small cap value manager, if memory serves. And they had very low turnover. And all I did was keep, and there for multiple years, they maybe sold, well less than 10% of their names. And I showed how the style box moved all around them, right? It bounced all around. And the reason why, of course, is, and this is one of the problems technically with the style box, both of the measures include market value of securities in there. The cap does, as well as whether or not something is value versus growth. And because of how Morningstar arbitrarily decides how the value versus growth continuum is done, they try and get it roughly a third, a third, a third. The box is what bounces around, not necessarily the manager's strategy. So that turns out to be a big problem. Final comment on this, I liken this to the following, and we're coming back to the top of the hour here. Michael and I said we're advocates for active management, and some of you may have heard me say this before. It's kind of like, imagine trying to construct a portfolio to win the 100 meters, right, in the Olympics. And the gold standard there, of course, is Usain Bolt. Now, if you're a manager, one approach to that would be, hey, I want to get a sprinter. If I'm a coach, I want to get a sprinter who has his body mass, his height, his weight. We might even have a really refined measurement of his chemistry and how quickly he converts calories into energy. We could look at his body lean out of the starting blocks. We could hire his equipment manager. We could obsess about that. But we always lose sight of the fact that the job is not to beat Usain Bolt, hint the benchmark. The job is to win the 100-meter race. And that's why our clients invest in this. They don't want Usain Bolt. They want to, they want to win the race. Anyway.
Yeah, and I got to add, because I care deeply about inclusivity, and we don't have to, but we could go on that tangent. But let's talk about inclusivity for our industry. There are people on this podcast who appreciate index funds and active. I would be one of those. It's not an all or none, folks. It can be a combination. But if you can't find active that's truly active, or you don't have the ability to do really deep research to find and hire the right people, and the stamina to stay with them when they go through their low periods as well as their high periods, then you're probably better off with an index. But the point is you can use both. I just want to be inclusive of the people and respectful. There's room for both in this industry. But if the active does not want to get crowded out by the index managers, you have to be active.
Yeah, I agree with that. I think there's room for both. And I would like to see a little bit of consolidation in the industry, not in the way people typically think of consolidation. They think of it as assets under management agglomeration. By consolidation, I would like to see those who are really outstanding and active survive and deliver the additional value for investors. I'm going to rewind slightly in the conversation. I have an issue with how our industry treats active and passive managers quite differently in terms of how they are evaluated. One obvious thing, though many people don't use the trainer ratio, the denominator of the trainer ratio is beta, which by definition the index is 1. So the index gets to keep any excess return it has, but an active manager, if its beta is greater than 1, is punished. Vol also in the Sharpe ratio, I think is a bogus risk measure. Many of you who follow my writing for a long time know that is a 20+ year odyssey on my part to try and change the conversation on that. And then finally, I'll say, okay, we're going to evaluate managers based on style box, and we're going to compare them to passive type products. Ergo, there must be some value add based on asset allocation that's being done behind the scenes, right? So an advisor or some other entity is combining different asset classes together for an overall portfolio strategy. Question for that: how is that evaluated? Have you ever sat in a meeting with a consultant who says, my asset allocation strategy, we reviewed it, and it seems I actually don't do a very good job of asset allocation. In fact, I subtract value in that process, and ergo, I'm going to exit that business. That conversation, to my knowledge, has never occurred.
Biggest potential crime, I have to be careful here, about the entire OCIO or institutional RIA business. They are about asset allocation. They're about portfolio construction, which, by the way, is by definition active, is necessary. It's a good thing, but they cannot even demonstrate. OCIOs, in fact, say they cannot show a track record because they're custom for every client. So think about this. You're getting paid asset management fees. You are performing some level of active management, and you're getting hired without showing a track record. Does that make sense to anybody? No. If you can't demonstrate skill, we've got security selection, bonds, stocks, or all of the above. Security selection, we've got portfolio construction, asset allocation, if you will. You need to establish, be able to demonstrate some level of skill with both. And it's funny, we don't talk much about the portfolio construction or allocation side at all.
We don't. And then final comment on this, and I've got a question for you, Michael. Your views on something. I don't know that I've ever really asked you about it before, but it seems part of the natural course of this. Again, fan of Morningstar. I'm a fan of bringing forth more information, especially about the funds, and I like the interviews with the fund managers. And certainly there's a marketing aspect that Morningstar provides. It's a way of getting the story out if you're a high quality manager to the investment community. My question is there strong evidence that the style box is predictive of future returns for the benefit of shareholders? And of course, I almost whisper this. How about the star ratings? They've been shown multiple times to not be predictive of future results.
The only thing, they've done research on this. Morningstar's done research, and I actually have some good friends there and people who are friends who used to be there. The only thing they show that seems to have any predictive level at all is fee level. The only thing they seem is the level of fees. Now, years ago, they created a stewardship rating in addition to their star rating. That has since gone away, but they still talk about all the factors. That actually seemed to show a little bit more predictive power than the star rating. The star rating does not. The star rating tells you who performed best recently in a category. But we know everything cycles. So the biggest indicator is fees. And isn't that interesting? Because the only promise that we have about the future in terms of performance is what we're paying for the asset management.
It reminds me, Michael, of I began my career as a research analyst for oil and natural gas, and those companies have no control over the top line really. They can overdo production relative to their reserves to drive short-term revenue growth. But most don't. They try and look at a reserve to replacement ratio of around 9. And they have no control, though, over the price of a barrel of oil or the price of natural gas, really. Some of the big players can kind of influence it, but not really. So one of the keys to evaluating the success of these businesses is the expense ratio. So it's no surprise that the expense ratio would be predictive of the results because we've chosen as a business model, as an industry, to make the expense ratio central to the evaluation. So it's no surprise there'd be a little bit of predictability. So a question for you, Michael. We talked about active, and we think active will survive. What elements of active do you expect will will surface more? In other words, where is the value add? We mentioned one, which is more flexible charters. Where's some of the other ideas you think will happen?
Well, longer time frame, and this is a double-edged sword because all things being equal, if you've got a good business, over time, the price of the stock should reflect that. So it evens out the short-term noise. The challenge with this is whether or not clients have changed or the industry has had impact on clients to change. Clients have become 3 years. I want to see numbers in 3 years. And if I don't have them, you're fired. So the way I thought about another pricing scheme, if you will, for clients is the longer you stay with us, the cheaper our asset management gets. You need to give them an economic incentive to give you more time if you believe that over time, your good thinking and research will bear out. So that's just one aspect. I really think we need to alter the incentive system to give clients the ability and the willingness to be more patient, because active management takes time to win. It's as simple as that. So it comes back to incentives to some point.
Yeah, I agree with you. I think that that's one of the levers that is not pulled quite yet. There are some firms that are sort of experimenting with that. I'll add.
I also want to see a size restriction.
Yeah.
I really would like to see it, and people hate me for this, but let me give you the poster child example. Renaissance, Jim Simon's Medallion Fund. One of the most successful books are written about the man who solved the market, right? One of the most successful funds ever. They discovered through all their math and research that $10 billion is the maximum. They return all profits every year to all of their employee shareholders, because nobody outside the company is in that portfolio. It's not allowed to exceed 10 billion. But yet, how many funds do we have in the industry that are way in excess of $10 billion of AUM? And forget about comparing across different size ranges in terms of small cap, mid cap, et cetera, or global. That's an important point, and I do think every style has an AUM capacity, specifically if we're going to go more concentrated. So I think that goes to, hey, we can raise the performance, but what does it do to the business? And that's the challenge.
Yeah, Michael, I agree. In fact, in Return of the Active Manager, Tom Howard, my co-author, and I endeavored to answer the question. It's one of the questions that came up in the questions over here, which is, how do you identify a closet indexer? The opposite question is, how do you identify a manager ahead of time that is likely to outperform? And it turns out we identified 3 criteria. Michael, you've heard me say it before, so cover your ears if you're bored.
Buckle up for everybody listening, because one of these criteria may throw you off your chair.
Right, yeah. I'm sure it's certain that it probably would. And again, a comment on that, right? Like ahead of time.
Well, here's the 3, Jason. Come on.
This is the seatbelt on the chair, though. As we're driving along here at 1,000 miles an hour. We were trying to get predictability, right? Statistical predictability. It wasn't likelihood, it was statistical probability. And so some of these measures were taken to the extreme because of the predictive power that we were trying to ascribe to the data. But the first is high conviction, right? And so we measured that based on the concentration in the top 20 holdings of funds. So you want high concentration. Lots of people have heard that before. The next was, ding, 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 per Michael's suggestion, individual strategies of 2 billion in assets under management or less. It's not that above 2 billion, you can't do it. It's just that that's when the curve, instead of additive in terms of, or not affecting returns, starts to change in terms of its slope. So it gets harder and harder. So I'm not surprised to hear Renaissance at 10 billion. And then the final one, this is where the seatbelt is necessary. Tracking error needs to be about 20% or higher. And of course, one of the answers to the who's a closet indexer was low tracking error. Well, said another way, it becomes predictive of active manager outperformance when tracking error is quite high. Said another way, again, if you want to beat Usain Bolt, don't lose sight of the fact that the race that's to be won is not to beat Usain Bolt, it's to win the 100 meters. We can't be like Usain Bolt. Usain Bolt is unique. We have to be our best selves. Michael, I'll pause. We're right at the bottom of the hour where we had promised we would throw up the polls. Do you have anything else you want to add on episode 1 here?
No, I want to, before we go on to the polls and answering Q&A from anybody who's with us here, this is our first podcast, so we're a little bit all over the place. We wanted to get an introduction and bring this to you. We wanted to give you a flavor for how Jason and I are willing to really pull the cover off and talk about some things that the industry does not like to talk about. We're going to go deeper and broader, but this is first one. We're going to poll you to get input. Where do you want us to go deeper before we get off? Because we're going to do this bi-monthly or every 2 weeks, so there's no confusion. And we're going to go into different topics. We just thank you for your willingness to join us for number 1. So it's a little bit more general today. So Jason, why don't you kick off polls or Q&A?
Yeah, and we'll do the
question through the chat box.
I think we'll do the polls first, just because people may be less interested in the questions. Who knows? And I'd like to get the data. But a comment, I neglected to mention that one of the reasons for this podcast is for Michael and I to share some of, I can't call them secrets, but some of the insights, I called them earlier travel tips from the journey that he and I have walked for, I think combined almost 60 years in the business. That's the point of this podcast, is to share some of those things that we know can help active managers do better. And it could be, you know, very.
Let's be clear about those travel tips. When Jason says what we've learned, Jason's been a PM. I've been a CIO. When I was a CIO, I had to hire and fire managers. It was an asset allocation technique. And yes, I did measure my performance and share it. But here's the point. We go and live with investment teams. That's our work with Focus Consulting. We go and show up at their, well, we used to show up at their office and live with them essentially for 3 days, 4 days, talking about these, working with them specific on what they're doing. Now we do it virtually. Folks, we go live with that. We learn things about asset managers and the talent that nobody else knows outside of the team. We don't share names, but we do talk about things that we've taken away from those experiences, some of our learnings.
Yeah, I would expect that's probably about 2/3 of what we may share with you. The other third will be things that Michael and I know from having many discussions over the last several years, things that we did that added value that we still don't see being done by most firms or funds, and which is surprising to us. And so that'll be part of what features. All right, I'm gonna put the polls up here. Michael, can you see the poll?
I'm not seeing the poll right now, but I had the Zoom chat open. Let me close that and see if that was obscuring.
I have just launched it. All right, there are 3 questions here. The first is, what is the future of the investment management industry? More consolidation, fewer active firms. This is multiple choice. Fewer active firms, passive dominates AUM. You can see the options up there. What would you like Michael and Jason to cover in 2 weeks' time? And we'll say a little bit about this. Idea generation, kind of obvious. We both have a specialty in how to improve idea generation. Interviewing executive management, which is a last mile kind of a job. Deception and truth analysis may need a little explanation. One of my specialties, and I've done research on it, published research, is on lie detection and truth detection in the industry and how to do it better. Behavioral biases, I see 1 vote for already. Next, alpha wounds. These are things that the investment management business does that hurts its own performance, kind of an own goal, if you will. Skills that separate you as an investment manager. This is some of what Michael and I alluded to. Meditation, that's a subject that's near and dear to my heart. Intuition, I wrote a book called The Intuitive Investor. And then Michael, say something about evolving processes and portfolio construction.
Well, listen, you know, people want managers to be consistent, but doing the same thing over and over again and not getting better results, right? This is what's known as the definition of crazy or insanity. So do what you're doing, begin to measure it, use that as feedback, and think about evolving your processes. The consultants, they don't mind if you evolve your processes, if you show data and evidence that you're looking to get better and better. The question is, are you aligned? Are you allowing data, evidence-based feedback to give you reasons to think about how to evolve your processes? And portfolio construction, folks, you can pick the best securities in the world, but if you don't have them sized right, or you don't sell them correctly when to exit, those are construction topics. The overall look and feel of the portfolio. A good sell discipline is shown in some circles to add up 100 basis points a year. A good size discipline that is effective, whether you're active sizing or not, has shown to add upwards of 25, 30 basis points per year. I happen to think that's low, but how the research is done is a bit squirrely. Okay, so think about that. Think about if you just did those 2 things better, you don't change anything about your research or your buying habits, which usually need some help. I'm giving you $1.25, 125, 130, 140 basis points of added value from no change in research. Portfolio construction matters. and it's too often a bit of an afterthought for how teams are designing their products.
Boy, does it matter. Again, data from Return of the Active Manager, the average research analyst actually adds between 160 basis points and 200 basis points of alpha. And this is net of fees, but once you add in poor portfolio management, you see the classic result. A bit of explanation.
Average research adds over 150 basis points.
I'm going to interrupt Michael only because apparently there's a problem with the poll. I apologize. It's the first time I've done one. If you cannot answer more than one answer, use that chat function. This is being recorded. We have the ability to download the chat function if you have more than one answer. And one point of clarification on the what is your role? FOM is friends of Michael. FOJ is friends of Jason. I saw my mom join at the top of the hour. Mom, you got to hit FOJ. I'm trailing Michael here. There are 3 friends of Michael, no friends of Jason. I'm quite disappointed. All right.
At this point, I'd like to say we're all friends.
Yes. Oh, yeah, of course. All right. So, Walt, I'm going to leave this up for you all to respond as you would like with the polling. There's some questions in the chat. Let's see. We've got one from Philippe, which had to do with how do you identify closet indexers? Michael, do you think I answered that well with the how to identify active?
I think you did, and I think some of our other listeners helped Philippe as well with that by posting links to articles about that. So Philippe, send us another question if you don't have enough right now. I think our audience chipped in, which is fantastic because we'd love to make this a dialogue.
Yep. Next question we've got from Svetlana Shulko. What do you think will be happening to the Footsie 100 in the coming months? I will take that one only because I have a particular fetish about this. I never answer that question. The only thing you can, as an investment manager, I think, or research analyst, manage, chief investment officer, whatever your role, is your process. The outcome is outside of your hands, and that turns out to be a very difficult thing for many people to accept emotionally. But I've never answered that question in public just because I think it's a tough one. Michael.
Well, my response to that is, why do you hate me? What do I do to you? Because no matter how I answer it, I'm going to be wrong. And why do you want to publicly shame me of giving a bad prediction?
All right, next question from Hansi, I believe. Why do closet index active funds still have any assets under management? Why do retail investors only have Morningstar star ratings?
I will say, Hansi, I only have 2 potential explanations. You judge whether or not they're any good. The decision to make an investment and give your money to a fund, or whether you're with an advisor or a salesperson, is a bit of a long, difficult, and can be a torturous decision. People don't like to make decisions. Once they're in, the inertia is really strong, because if it's not performing well, they have to admit they made a mistake, or they have to fire their advisor. 2 things they don't like to do. It's not a tendency. So my first answer is inertia is really strong. The second one is, and I'm ashamed to say this, to a large extent, they probably don't realize they're underperforming. They probably don't know the data, and the way it's being shown or demonstrated, it's in such a way that they may not understand. Financial literacy is a massive challenge in this world. So inertia and financial literacy, Hansi, I hope that helps.
Yeah, I'll answer there. I think there's no one answer. I think it's all over the place. One is effective mutual fund and fund marketing. One is sometimes the AUM it's agglomerated in a product like a 401k or some other retirement account where it's just one of the options. And so it's been chosen by a committee maybe years ago, and it's still on autopilot. And so there's money there only by default. Some of it is, I think, Michael, you said it, ignorance on the part of either the advisor or the investor, not paying that close of attention to it. I think there are many answers as to why.
Yeah, and I'll give you the most shameful example I can think of. This is from years ago, so don't try and find this. Mutual fund in the U.S., actively managed, portfolio manager died. And years later, there were still assets in the portfolio. There was not a co-PM. There was not an APM. There was some analyst assistance. But when the portfolio manager dies and the money doesn't move out, you know, barring a wonderful organization behind the portfolio, and there are some wonderful organizations, it raises what's going on here? Do you know your manager died? I'm sorry, I had to share that.
Yeah, I think that this is one of the things that I hope changes in the investment industry. Michael, you said something along the lines of, it was pretty harsh, but I'm trying to steer toward moderation on our first podcast here. I can wax loud on this issue. Yeah, I think it's just inertia is what I would chalk it up to.
That's why that was my number one. It is inertia.
Yeah,
it's really powerful, which is also why the active management industry hasn't become more active sooner. Concentration, changing of fees, they're not adopting these better habits because of inertia.
Yeah, and I think also, frankly, when you have 40% profit margins, which the fund management industry has for decades, there's not a lot of incentive for you not to asset and under management conglomerate and to market the heck out of. It could be accidental that you're currently a 4 or 5 star fund, and it behooves you because of the business model to market the heck out of those funds and agglomerate, which is another form of inertia, I would add.
We have another question that came in from Kyle Berkowitz. It was sent to everybody, but Kyle, if you don't mind, Jason and I maybe take it on. Do you believe the Fed's extensive printing or involvement in the market will deteriorate the US dollar and have severe damaging effects on the US economy long term? Jason, would you like to take that first, or shall I jump in?
I think it's maybe the least involved answer I've ever had. Yes.
Okay. Well, Kyle, nothing is in a vacuum. I would say that the actions by the Fed are damaging, if not risky. However, we have to then look at the alternatives, right? Because the money has to go somewhere. So what other deep, broad markets, free flowing currency, where can the money really go? Is there a good number 2 alternative? China's currency is not fluid or liquid enough. Question about the depth and breadth of their market. They're so heavily oriented towards tech. The US is the broadest, deepest market, arguably in the world, with the most liquid currency. So is there risk, Kyle? Absolutely. But before I go doom and gloom, which people who know me, I'm capable of doing, I'm not certain that's necessary here, because I don't know where all that money would otherwise go that would feel comfortable enough in parking it.
Yeah, and I'll add, one of the issues here, and that this is a little bit tangent, it's not entirely within the realms of the question, is, and this is a market structure issue. There's a lot of money in public markets chasing very few assets. And one of the things that's a little bit alarming to me, and I've written about it, did research on it at CFA Institute, was read into congressional testimony here in the US, was the decline in the number of listed equities since the mid-90s. And that turns out, I think, to be a problem. But you also have a lot of money that sort of, for lack of a better word, it's sort of constrained because of the way markets are structured. I think that's a factor. So a lot of that money finds its way to the public markets, including real estate, for example. And I don't know where it necessarily goes. Next question. Let's see here. When will passive destroy price discovery that active provides? What % of passive in the market will do this? Michael, I have an answer there, but I just finished. Do you want to take that one?
Yeah, I have a gut feel. I've seen various research pieces that have come out on this, and my gut feel is about 80-20. And please excuse that reference to the fabled 80-20. I think that passive, and if I may ask everybody, can we please stop using the word passive? It's not passive. We'll call it an index fund. Index funds, I think, can get up to 75, 80% before they severely damage price discovery. Another way of asking it, how has the massive growth in private equity hurt price discovery? But we're not going to go there necessarily because you didn't ask.
Yeah, I don't really have an answer necessarily on that. I think it's a very complex question. I will point out in the maybe just a personal pet peeve of mine. It was a something that was a little bit controversial internally at CFA Institute. This notion that active should be supporters subsidized in some way to support price discovery, or that active is zero sum. I would point the questioner Bob to a recent blog post I did, and I said active management is not zero sum. It comes from that notion that it's zero sum from a very narrowly defined market. But if you look at the original work that outlined efficient market hypothesis, CAPM, and the efficient frontier, there's absolutely nothing in there that says that the market is the S&P 500 or the Russell 2000. In fact, what's described are any asset, basically. And when you broaden it out to that, it's impossible to own, quote unquote, the market. So it's entirely possible to add non-zero sum returns. One simple example, and by the way, I'm a huge fan, this will be a recurring theme, I'm certain at times, I hate false absolutes. There, by definition, if you understand math, there shouldn't be only one absolute. That's probably the set that includes the empty set and all other sets. And anything else is less than, meaning you can always find the exception to the rule. So as a fund manager, there was a time when I was the only holder of a Halliburton convertible security. And so there was no other market for that. And so I was the market effectively in that. And by the way, that turned out to be a great buy for me and my shareholders.
Yeah, let's just go back in time. You're right, 1950s when the beautiful work was being done by Markowitz and Sharp. At the time, S&P 500 was called the market. It was the only thing there was readily accessible, available information on. That's why it was referred that way. Hansi asked a follow-up question.
Before you go, sorry, this is also pre-calculator, right? It was like slide rule era that these things were sort of first formulated. The point I never finished about CFA Institute on active was Paul Smith, the former CEO of CFA Institute, published an op-ed, I think in the FT, or it might have been on Bloomberg, saying that price discovery was active's best hope. And by the way, if it's not obvious, Michael and I stringently disagree. And that could be, in fact, the focus of one of these podcasts, how we believe active is misrepresented. In fact, that may be today's sort of implicit theme is active is misrepresented. Michael, to Hansi's question.
Yeah, Hansi, you came back and asked about the inertia topic in our response earlier, and I have one really off-the-wall idea on how we can help with inertia. Make investors rebuy their investments every couple of years. Means if it's still in the portfolio, they have to make an active documented decision. I still want to own this. Or when you start to make people face choices, and this is a double-edged sword, mind you, because of behavioral issues, but when you start to make people face choices, they will make some choices. So the fastest way around inertia is to let people know at intervals of time they actually do have choices. They don't have to stand pat. The danger in this, of course, is the inertia can be a good thing too. So if you're going to present choices at intervals of time, then we need to make sure that we craft these choices really well from a behavioral standpoint. And yes, I do have strong ideas on that, but that's beyond the time we have on that topic today. We can come back to it in a later podcast.
Yeah, Hansi, you'll like my answer because of I'm aware of one of your things you do is investor education and that you're quite passionate about. I think that is a key step. Sadly, though, I think there has to be not just a supply push, meaning we're willing and stand able to educate investors. There needs to be a demand pull. And frankly, I'll tell you, I just have never seen much energy from the investing public for spending a lot of time trying to understand investing. I think most people see it as a necessary evil, and that I think we as an industry can weigh in on that subject and change that narrative. But frankly, many people are overwhelmed by the material, and so they don't know what they don't know, is one answer to the question. And I think we just have to keep doing it. I'm quite enthused by things like robo-advisors, specifically because they begin to give options to investors that weren't there previously. I'm a huge fan of things like Investopedia that allow people to answer questions. I'm a huge fan of anything that helps with investor education because
as long as there's a human plus the robo, I believe the combination is better than either alone.
oh yeah, sure, yeah, quite, as they call it, centaur in that space, uh, which is the combo of machine and man or person.
We have another question that came in, Jason, that I'd like to take because it touches on something I said already and something we already discussed. Is, will the continued movement towards indexing kill capitalism, as some have suggested? And it won't. But there's a problem with why I say it won't. The private equity space has grown to such an extent that it is an outlet that can help preserve capitalism. The reason I'm not a fan of this is because, as we know, access to public markets are public. We can say to a large extent it's democratized. Access to private equity is not democratized. And by the way, if it goes towards democratization, expect that market to get slaughtered. So my point to answer your question, Ed, is I don't think it will kill capitalism, but I'm worried about creating a two-tiered market set where we have the simple, boring few public equities, and then we've got this massive private space for people who are high net worth investors or people who have access. And that I do not appreciate.
Yeah, I echo what Michael said. One of the things that I've spoken about publicly and considered an important subject is we talked earlier about making charters more flexible for investment professionals. Right now, most are limited to public assets. And it's long been the case that liquidity is the dark specter, right? I don't want to have too many private assets in my portfolio. Boards don't like illiquid assets, et cetera, et cetera. But if our skill is to identify great performing businesses or investment ideas ahead of time, I would expect that one of the ways to mitigate this, I wouldn't quite phrase it destruction of capitalism. I think capitalism is pretty robust. It's a systemic thing. It's an adaptive mechanism. I think it would adapt. I would say that part of those charters, as they get more flexible, will include more illiquid assets. Whether that's private equity, whether that's commodities, whether that could even be something crazy like artwork, for example. I can imagine a world, I'm not saying this is a high probability, but I can imagine a world in which there's a fund out there that hires curators of museums and they select artworks to put in the portfolio. And it maybe has a time horizon embedded in it. It's maybe 20 years out, and like a hedge fund, it's a vintage and it cashes out. It could be 15, 10, 5. I don't want to debate the time horizon, but the idea is that you can package up illiquid assets in a packet in some sort of investment vehicle.
So we are at a few minutes to the top of the hour, and I think with respect to all of your wonderful patience of those who are still with us, we ought to let you go. We ought to say simply, thank you so much for joining our first. We hope you don't think that it was a failure. We hope you come back to second, third, etc., where we can go deeper on more focused topics. We'll still waver around a little bit because that's just who Jason and I happen to be. But we're going to be more focused on things that you're asking for, and we want to go there. The last thing I'll say for those of you who are really impatient and can't wait 2 weeks until the next one, Jason and I are both fairly active on Twitter. I tweet a lot of these types of things, and I'm very into public policy for those who have that same horrible affliction. My Twitter handle is at M for Michael, S for my middle initial, last name Falk, F-A-L-K. So I look like Ms. Falk on Twitter, but I am not Ms. Falk, simply MS Falk. I published 2.3 books. You will see stuff about my books. I'm trying to make a positive difference in society. I've taken on public policy in 2 of my books in big ways. So let's keep in touch, and please come back in a couple of weeks. Thank you so much for participating today.
Yeah, and I'll add my Twitter handle on there too, @TheIntuitInvest. Of course, Michael and I are also active on LinkedIn. You can email us. You are mfalk@focuscgroup.com. I'm jvoss@focuscgroup.com. We'd love to hear from you. We consider ourselves citizens first, investors second. And so I would imagine that these podcasts going forward will be exactly as Michael described, which is all over the place, but with a focus, of course. We don't want to waste anybody's time. Thanks so much for joining us today. Take care.
Thank you.